And here at home, the Federal Reserve is raising interest rates for the 10th time in a row. The quarter-point hike comes just 2 days after the collapse of First Republic Bank. The latest reports show inflation is cooling a bit, but growth slowed in the first 3 months of the year. Business reporter Alexis Christophorus is here to break it down for us. Alexis, what does this new rate hike mean for people with credit card debt?
The news is not good. If you have a balance on your credit card every month, you are going to be paying more. So rates on credit cards were already at a record high before yesterday's Fed meeting. So now the average rate on a credit card is going to be about 20.5%. So you should see that change happen in the next 1 or 2 billing cycles. Of course, if you pay off your credit card balance at the end of each month, you don't need to worry about higher rates. And you should know that if you're perceived as a riskier borrower, rates on credit cards for you could go up even higher. In addition to credit cards, it's the same story. We're going to see rates go higher on auto loans, personal loans, home equity loans. Mortgage rates are not directly tied to what the Fed does. They more look at what's happening with inflation and the economy. So ironically, if the economy continues to slow and inflation continues to come down, mortgage rates might actually tick lower in the weeks ahead.
Interesting. Now, I want to ask you about PacWest Bank, too.
Yeah.
They're based in California, and the bank now says it's exploring strategic options after the stock plunged. Is that Wall Street lingo for please help? What's going on there?
Yes, it could be perceived as such. You know, investors are waiting for the next shoe to drop with all of this banking turmoil. PacWest may be it. It is a much smaller bank than Silicon Valley Bank and First Republic Bank. It has about $44 billion in assets. It's based in Los Angeles. The stock is down 70% since the beginning of the year. So they are definitely looking for some help. They're saying they're exploring all potential options, which include a possible sale. So it looks as though, you know, the turmoil in the banking sector is not over yet.
So what are you watching for now, both in the banking sector and in terms of possible future rate hikes?
So we want to make sure that the banking sector can stabilize, that people are not withdrawing their money out in droves, which I must say has stabilized in the past few weeks. Even PacWest said we're not seeing a bunch of people coming in and asking for their money to be taken out. But in terms of the Federal Reserve, they did hint yesterday that this rate hike may be the last one for some time. And some are even saying the Fed may cut interest rates later in the year if they feel that they need to, if inflation is under control. So one word of caution, if you have not locked in a good interest rate right now, say you're looking at a CD or a high-yield savings account, do it right away, because those rates have probably peaked, and if anything, those interest rates will start coming down in the weeks ahead.
It's a great tip. Alexis Christophorus, thank you.
Hi, everyone. George Stephanopoulos here. Thanks for checking out the ABC News YouTube channel. If you'd like to get more videos, show highlights, and watch live event coverage, click on the right over here to subscribe to our channel. And don't forget to download the ABC News app for breaking news alerts. Thanks for watching.